and a little review of market thoughts that are just posted. So this is basically for yesterday. I got busy in the afternoon, but one of the things, I'm still looking at is this gap fill. Posted this, gone over this every single day.
This short clip is presented by Club. Club provides access to Samantha LaDuc and her team of professional macro and micro traders, analysts, and educators. Club is ideal for active traders, investors, and institutions who want Samantha's best-of-breed market timing calls across all asset classes and timeframes like chase, swing, and trend. Get the trade before it happens. Sign up to Club now and get full access to daily live trading room with Samantha LaDuc, Slack trading desk with detailed analysis and trades, custom trade support when you need it, and much more. For more information, visit www.laductrading.com/club.
This is the November 30th gap up Monday into FOMC. Just a reminder, this is SPX roadmap. It's a 2-hour look. It's basically the 1 hour condensed to 2 hour time that I normally show the 1 hour time frame. In any case, you got a gap up here, a gap, another gap, and then this big honking gap. Anyway, anything above 4,400, the likelihood was that we were going to head up and fill this gap of 4,500, then basically this 4,600 area, but specifically 4,575. All right, so we got lots of gaps in the downfill that we can't fill until we finish this last one, which is August 1st, right? So this is the last FOMC with Treasury issuance, and basically we had a fall from 4,600 down to 4,100. That was the gap up into FOMC, and then the Yellen, the FOMC, Fed pause, and the Yellen Yahtzee with the more bills and bonds and all that. So here we are, moving on up. Today, we have FOMC minutes from the last meeting on November 1st that are released, and we have Nvidia after market close. So my bet is, obviously, we're going to fill this gap on the hourly. The question is it before or after Nvidia reports? So here are thoughts from Craig right here, Macro Musings on FOMC. And by the way, he's on vacation this week, but he's still working. So we get the Fed minutes. This was actually, it is today. Reminder that the Fed is in buying time business, which means they are looking to sell vol when it gets too high, which is where it was, close to that 23, 24, 25 area back in October. And then now it's at 1338, right back to monthly and weekly support. Anyway, they want to prevent a massive risk asset correction, but also look to buy vol when it gets too low in order to make sure they can actually meet their mandate of slaying inflation back to 2%. So let me just kind of show you that VIX that I was referring to. Remember this 1338, how many times we kind of like hugged it, popped up, hit the 50-week, came back down, and then this was a gorgeous reversal pattern because the 10 and 21 crossed over. And then we were looking to see how it was going to do with the 50-week. It did very well above the 10, above the 10, above the 10, above the 10. My line in the sand was anything above 2044. We were going to head back up and tag that 23. We did. We did not get up to the 26 area. That would have been needed. Would have needed to see continuation. And obviously we did not. But the point is we definitely had a wallop of a massive volatility sell-off on that November 2nd timeframe. And now that we've had that sell-off from basically 23 to 13 again, this is typically where it bases and starts to think about percolating higher. So it happens to correspond with that kind of 25.75 right as we get into Nvidia earnings. So his point, since the meeting, which is November 1st, both equity and treasury vol have fallen massively. He's talking about the MOVE index and now sit toward the very lowest levels of the year, which I just showed you. Financial conditions have eased massively, and the market is looking for 4 cuts next year with a close to 30% chance of a cut in March. So they've moved up their first cut. Remember, it was in June. Now they've moved it up to March. This has happened despite core services inflation settling in the 4% range, wage momentum still firm, and an economy still looking at 2% GDP growth in the fourth quarter. A little odd, huh? Why would they cut if, things are going swimmingly? Suffice it to say, the market has sufficiently front-run the Fed's reaction function again. in a still sticky inflation environment. Couldn't agree more. That isn't falling as rapidly as the market believes. Inflation expectation survey data also remain rather firm and figure to move higher if the stock market continues, to also move higher. Speaking of which, I talk about this phenomenon, right? We've had 3 solid weeks of gains, and we're just starting the seasonally strong period of the Santa rally. So we're either going to go into parabolic mode, which I've also warned, this is looking a little 1990-esque, or we're going to start getting some volatility seep in instead of the Santa rally. Anyway, as a result, his point is, I would look for the minutes to read hawkishly tomorrow in order to dampen the animal spirits and remind the market that the Fed will not be quick to cut rates this cycle to address the growth slowdown that is on the way, especially ahead of another PCE print coming next week. Look for the Fed. Oh, by the way, we also have jobless claims coming tomorrow, which I'm always very, very, very focused on that. Look for the Fed to try to get optionality back from the market and push out once again the timeline until Fed liquidity is coming. I would expect higher front end yields and lower stocks, especially cyclicals and small caps. So that's kind of the reaction function of how he is playing the FOMC minutes. In other words, tamp down some of that cyclical excitement and small caps. So that was the gist of the SPX roadmap I kind of wanted to show, plus the dollar falling because we have some very strong Asian currency rollovers as expected. They were expected to intervene. They did. This is Bank of Japan in the Dollar-Yen on a 1-week time frame. This is PBOC, Dollar-Yuan on a 1-week time frame. They were absolutely expected to kind of come in there and do something, especially at the 152 area for BOJ, and it has come back down. Here's some support on a weekly. We'll see if that holds and then bounces about for a little bit, but that yen bounce is in play. So it definitely spiked higher yesterday, showed you that, and it has continued this morning. So they kind of continue. K-Web and others, which especially BABA looks like it's done going down for now, still needs to base. But the point is, this is already broken its trend line, and this looks like it is about to. That's on a daily time frame for the yen, and then you know what happened with the dollar yen. You know what happened with the yen bounce, specifically FXY had a nice gap up. But this is what I'm going to be looking for now, right now. So this is the regime rollover, I should say, in the dollar. That does not look, and this is on a weekly, this is our Dixie, that has 103.38 that we're hitting this morning. Okay, so this has literally gotten rejected at 107. And I said, if it comes back in 105.77 on a weekly, we were going lower. We did 3 weeks ago, which has helped cause the market, bounce of size. And we have continued to roll over. And this is where I expected we would have a little bit of a shimmy and bounce. We're there this morning, and you can see my kind of stochastics rolling over. Here's another, cherry-picked indicator rolling over. We get into a very, very firmly bearish dollar mode once we get and stay back above this 0 mark. So I'm really kind of focused on this. We had a very strong dollar advance until the Bank of Japan and coordinated central bank intervention back in September, October of 2022. The dollar came down, equities and bonds stopped falling. Equities outperformed, especially Mag7, right? They literally outperformed this year like 105%, just, those stocks compared to 19% if you include them in SPY. So we're not talking equal weighted or, 400 and SPY 493. We're talking about just the Mag7 stocks performance 105% this year. And then SPY with Mag7, crazy, I know, right? All the weighting, almost 20% so far. So we got this bounce off the bottom here in January has been helped all because of the dollar and yields falling. So they should be helped with a break of the dollar falling below that 103.38. In particular, I think commodities will benefit more. But for right now, that's a bounce area. Okay, so there's short duration. Let's get Nvidia out of the way, FOMC minutes out of the way, and expect the timing of VIX at 1338 and the dollar at 103.38 as a potential area for some volatility. So we'll have to see what happens with Nvidia. If truth be told, they really are going to set the whole momentum stage here on the sentiment front, and FOMC is going to set the stage for the yield and dollar bounce most likely. Intra, you can see already on the dollar, this is all same idea, right? The 2-hour intraday or pre-market. We had that drop, one and done. That was the tease on the 23rd. And then that was it. It was absolutely done on Friday, November 3rd. The dollar had already gapped down on the 1st into the 2nd. The market gapped very strongly higher. And that was when we were in trouble. Bears had to cover. This was just, that was it. And then once this broke down 105.77 on a weekly, that's it. Dollar's in a short regime. And I wrote about that. In fact, I specifically wrote about that on the 9th and the 10th. I said, I think this thing's going to continue to roll over. It's not just fallen, it's peaked. So I'm still of that mindset. However, I know we can have a bounce. Gold is above that 2,000 as a dollar yen and dollar yuan are rolling over solidly. And the Qs are getting a little nervous ahead of FOMC minutes and other news, but also Nvidia lightening up into that print. Yields are a little bit flat, and you can see that with bonds. They're still doing this kind of left shoulder, head, right shoulder. This happens to be ZB, but you can use ZN or TLT. That's on a weekly. Again, big picture. We still rolled over massively, right? Bounced into a 40-year trend line resistance, crashed during 2022, and then central bank intervention of size helped that stay of execution. But since then, that was just diminishing returns, right? All that money really didn't do much except for equities. They still didn't buy U.S. treasuries en masse. Anyway, here's where we're at now. It's just having an oversold bounce. We'll call it the Ackman bounce. And then here is the dollar, right? There's that breakdown of 105.77 and woo. So we're even below my 103.38, by the way. That's in this neck of the woods, right? So we're even below that. That's a big a deal. Look at the dollar yen. As seriously, this is the October 21st Friday intervention, and they have been trying a little bit here, a little bit here, a little bit here, and a lot here. So that yen is moving higher. That was the expectation. Gold is also moving higher with yen, and typically, so will bonds. So that's kind of the trifecta. When you see a pullback right here in the dollar yen, like it did up here, we had a very, it's bonds stopped going down, right? So that's what you're looking for. Not only does gold go up, yen goes up, and then typically bonds too. So we'll have to see about that. But there's your JGBs. Remember that if 80, then 100, then 100, then if 100, 80, well, we're all the way down to below 70. So they're definitely coming in here with guns blazing. However, that is just a trend line tag. All right. So then on the other kind of not intermarket, but dollar yield, you can see we were risk off, anything above 300, risk on, anything below 300 in this ratio. Again, dollar yield. And then on an intraday time frame, that's not the one. There it is. On an intraday time frame over here, you can see this runs inverse. As this is falling, market goes higher. If it rises, the market gets hit. In other words, it falls. Anyway, the point is this is surely well below 300, my 295, my 292, my 288. So this thing is continuing to fade. And at some point, we're going to have a sharp little rally into the underside of this 300. That's going to be the volatility I'm talking about. So if dollar bounces right here with yields, we come right into this underside of 300 most likely. Then we need to see what happens. But in the meantime, you can see what's happening with the Mag7, right? This is on a weekly, and it's all the Mag7 in one chart. They are still right off that August 27th warning. This was absolutely bounce hard or trounce hard, and we got inside and moved strongly. This is the top. I think we hit our heads and start to roll over. All right. And this is the growth value rotation I'm talking about in the write-up. All we're doing is stabilizing up here. We haven't broken down. There's been no trigger. We have a little bit of weakness, but nothing has triggered. There's been no Bitcoin selling. Oops, sorry. Either. So not for nothing, but we still have a momentum backdrop of strength, big picture. All right, so now the market's open. We got a little bit of weakness, nothing too, I would say, I don't know. I like the word dastardly, but long story short, this is still a gap fill. It should fill. That's it. It should fill, and then we should have the pullback. It should have a relief bounce, even though I believe the dollar has peaked, and I wrote about that in detail, right? So that's one thing is a macro backdrop, a big market trend, a big macro trend is the dollar has peaked. And I wrote extensively about that, like not a little bit, right? Not a little bit, but a lot. So this right here, Friday, November 10th, and I did an interview about it and the whole thing. So this is a big thesis of mine for the year, but I also am aware that we're absolutely on a bounce level. So dollar higher, yields higher, we could have some volatility come in for sure.
Subscribe to LaDuc Trading YouTube channel for more live trading room recap videos and other content.